Okay, what's up guys? I'm going to show you how to buy a contract, an option contract, which gives you the right to buy 100 shares of that company. I'm going to show you how to buy it for cheap or cheaper. So say you see, here's Square today. Say you see signs of Square having a reversal. It's had a couple down days and you think consolidated here. Here's the 190-day moving average. Here's a 9-day moving average. It's bouncing off of this. Some solid green candles above the 9 moving average. I see a lot of strength here for it to reverse. The MACD looks good. It's over the MACD is over the signal. I see support here and it looks like it's going to come up here. So you want to buy an option contract instead of buying shares, because if you buy shares, let's see, it costs $139 for one share. And if it goes to 155, great, you've made whatever, $20, $15. So if you want to make more than that with that $150, you use options because they have leverage. So you go to the option chain. This is how it is on Webull. I'll show you on Robinhood too, but give you an idea. So you think, to be it safe, you're going to give it some time. So you think maybe by September 11th. Never forget, always remember. Or even let's see at September 18th. See, there's more here on this one. That one was a weekly. So you think, okay, it's gonna go up to 158 or around there. So say 160, and then to be safe, you want to go one below it, 155. Yeah, that's probably pretty safe. You can look at the delta, 0.37 means a 37% chance it's gonna get there. It's somewhat volatile, not too bad. Plenty of open interest, plenty of volume. Okay, it costs $570 for one contract. Maybe you could get it for $560 or maybe $555. Probably not, but probably $570. Okay, if you don't want to spend that kind of money, but you think it's going to go up, here's my Robinhood account. So I'll show you what I entered in today, because I do believe Square is going up based on those different indicators I showed you. So let's see here, where are we? Okay, Robinhood. So what I did was what's called the debit spread. If you guys know how to do debit spread, you don't need to pay attention. Disregard. Basically, it's very, very simple. So let's view the options here. So we were looking out the September 18th. I don't remember which one I got. I forgot September 18th or not. Doesn't matter. Let's say I thought I was going to go to 160. If I bought this one, great. $438 that would cost. Now let me look at my E-Trade and let me show you what this means on E-Trade, the probabilities and all that. Square, this will show you the probability of said contract expiring in the money or the profit you're going to get, yada yada. So that was September 18th, 160. That's this one. I don't know why it does it like that. 160 call. Let's look at, well, first of all, we can look at the chart here. This is kind of a cool thing that I started using on E-Trade first. So this actually gives you the option pricing chart. So what point this option, what price the actual contract was worth. So up here, look at that. It was selling for almost $500. Wait, no, that's not right. Oh, there. It was selling for almost $1,300. This contract was worth on the 5th of this month. That's insane. So let's just look at that. I like to look at that and see this huge green day, this huge green candle after hours. They had news, earning something, and then even though on the 5th it was going down, it wasn't a red day, but it was going down. That same contract that is now costs $438 on that day. Look at that thing. Dude, where the heck? Where'd it go? I got out of it. 160. Why did that happen? No. Okay, chart. I think that's so cool to just look back and see. So if you bought it in right here for $400, which is about where it's at now, $432. See, I'm looking at this number right here, high open. So 450, say 400, that's where it's at now. And then the next day, that thing would have been worth $1,200. That's sick. I think if you just bought a couple of those, huge gains. Anyways, so that's kind of the option pricing there. But what I wanted to show you was if we bought that 160, is that what we're doing? 160 call for September 18th. So let's just say we want to trade that. All right, so mid price, you're gonna spend 438. Let's look at a little snapshot. Hello? Limit price increments of 5 to 10. Okay, it doesn't like that price. There we go. Oh, it doesn't like that either. Okay, whatever. 435, say you buy it for that. So your max profit is infinite, of course, because it's an open, naked call. So yeah, if this thing goes to the moon, if it goes to $10,000, you're gonna make a ton of money. Max loss is just the cost that you spend on the contract. So we would spend $435 to buy this contract. Now the probability, see, does I have it on here? Max profit probability is not applicable. Break even is 19%, max loss is 76%. So there you go. You have a 24% chance of not max profit, but expiring, I guess, in the money. So those chances aren't great. But if you have a strong belief, go ahead and do that. And if you want to spend $435 on that belief, then great, buy a naked call. If, however, you have a strong belief, but you don't want to spend that kind of money, what you do is you go to the strike price below it and you sell a call. So what you're doing here, are you below it, above it, below it, above it, below it? Nothing's working right now because the market's closed. You go to the one above it and you sell that one. And what that does is it basically just cheapens up the trade altogether a bunch, and it caps your profits. So if we added one here and we sold it, so it's 165, the strike price right above it. So we're buying the 160, and then you go one higher strike, 165, because that contract is cheaper. So you sell that one, so you're still going to owe money. Why is this saying 435? What? Oh, there we go. Okay. So instead of it being $435, you're only going to spend $97. Okay, so that's a huge discount on that same contract. Same date, same strike price, everything. The difference is this is your max profit. It's capped at $403. Probability of success is the same. All that stuff is the same. However, if we look at options profit calculator, this is kind of a cool site, and we do call spread, and then we look at, we're looking at square, yeah, square, and then we're buying 18th of September, we're buying the 160, right? Is that what we're doing? Buying 160, selling 165. So this is buy, 18th September, 160 call, right, which is selling, right, is the same as selling, 165. Call, 18th September, same day, both calls, one we're buying, one we're selling. Net debit or net credit? Net debit, that means you're spending 0.98, which is $98, and you calculate. Then here you see this chart. This chart will give you kind of everything. So on this day, let's say September 3rd, the strike price is at 152. If it's come up to 152, you're going to be 28% richer, $28. So this will give you a good idea on, depending on where the strike price is on what day. And then if it comes down here, of course, you're going to lose. But then let's look at if it was just a naked call. So naked. So then we'll do square. Right. Oh, we're going to buy a call. 18th of September. Is that what we're doing? Yeah. 160. That's what we believe. Let's calculate. Let's see. Whoa, okay. So you see how that one is compared to the other one? The other one, we do it side by side, but if you just go back, you'll see it. The other one, it was much more gradual. It was a much more gradual chart where basically you'd be profitable. Oh, hello. Where you'd be profitable even if it wasn't up here. It could be down here. Lower strike price further out time, and you'd still make money. So the chart was much more forgiving, basically. And I've noticed that with debit spreads compared to just naked calls and naked puts. All this applies to puts as well. If it's a covered put, you do the same thing, but with a put. So let's do that. So if you think, no, it's gonna go down, you would say, I want to buy put 125, and then I want to sell one. Now in this case, you want to sell one that's further, so further from the strike price, because you're doing a debit spread, put debit spread or call debit spread. And then this one would, whatever, it costs you $94 instead of costing you $338. You'd cap your gains, but you'd be much safer because this chart right here shows it. Long call, look, even if it was at 157 on September 9th, you'd still have lost some money on that contract with just a naked call. That's how I get into contracts cheaper. That's how I'm transitioning into. I'm sick of all these stupid contracts that just expire worthless. You spend your money. This is a super cheap one, but you know, it's crazy. If it doesn't work out super aggressive in your favor, like a chart like this where it just shoots up, crazy volatility, it's tough. So you cap your gains with covered, or not covered, but a debit spread as opposed to just a naked call or naked put. However, it's worth it. It's safer. So that's my little video. Like up, sub up, comment down, make your money happy money, make some happy money babies. And then yeah, have a good day. Thanks for watching. See you next time.